Hello there, I'm Professor Indra Abeysekera. One of the learning goals in this workshop is to understand how to account for impairment and revaluation. There are two models of recording cost of tangible assets. One is the cost model, the other one is the revaluation model. In both models, no matter what, there are assets that are recorded. They will undergo losses, decrease in values. Decrease in value due to time and usage, which we call depreciation expense, and decrease in value due to market forces because the market value of those assets decrease. That is called impairment loss. Both the cost model and the revaluation model must record impairment loss. To find out whether there's an impairment of an asset, that is a decrease in value due to drop in market value, we need to conduct an impairment test. Impairment test compares the carrying value of an asset with the recoverable value of the asset. What we mean by carrying value is the cost less accumulated depreciation and accumulated impairment losses. That is the carrying value of the asset. That should be compared with the recoverable value of the asset. And what is recoverable value? Recoverable value is the higher of either the market value less cost to sell or the present value of the asset if that was used. So there are two choices. One is sell the asset, company can sell the asset and recover money, or keep the asset and use it, generate cash inflows. So logically, a company will do whichever is giving the higher cash flow. So we take the higher of the two. But when we take the cash flow, we have to, because we are in the present and the cash flow is in the future, we need to find the present value of future cash flows. We need to discount it to today's value. But we take the higher of the two because logically either we keep the asset, company keeps the asset, or sell the asset depending on whichever that gives the higher cash flow. Then that will be compared with the carrying value, that is the value that is recorded at present. And if the recoverable value is less than the carrying value, then we must decrease the asset value to match with the recoverable value. The decrease in value under the cost model is called impairment loss. Let's say the carrying value is 300, recoverable value higher of the two is 250. Then the drop in value, we must decrease the value to 250. We need to decrease by 50. Impairment loss is 50. Under the revaluation model, it is the same loss, but we use a different word and we call it loss in revaluation. But it is the same thing. So let's take an example. If we use the asset, then we will get a cash inflow in present value of 55. If we sell the asset, we get a cash inflow, we get once we have sold, and after selling cost we get 60. So the higher of the two is 60. Then we compare with the carrying value, which is 70. We need to decrease by 10 because we need to bring it down to the carrying value 60. We need to bring down the carrying value 70 to the recoverable value of 60. So the decrease is 10. Although we conduct the impairment test by finding out the recoverable amount and comparing that with the carrying amount, it doesn't mean that we will make a decision either to keep the asset or sell the asset, but it is a test that is conducted so that we can adjust the accounting records to reflect the economic reality of the assets. Impairment loss applies to both cost model and revaluation model. As I said, under the cost model we call it impairment loss. Under the revaluation model we call it loss in revaluation. When we apply whichever method, whether it is cost model or revaluation model, we must apply to a class of asset. The impairment loss can be reversed in the future. For example, if the asset value, the recoverable value increases in the future, then the loss that we have recorded as an expense in a previous period, in this period we can record that amount of loss by reversing it. We treated it as an expense in the previous period. In the current period, we treat that as an income so that the previous loss is reversed.